In 1989, the United States government became the largest real estate owner in America overnight. They didn't want to be, they had no choice. The Resolution Trust Company, created that August, held $450 billion in assets. Office buildings in Houston, shopping centers in Phoenix, apartment complexes across California, half-built developments that nobody wanted to finish, non-performing loans stacked to the proverbial ceilings. It was the largest forced liquidation in American history, and the people who understood what happened became billionaires. Zell, Barry Sternlicht, the founders of Blackstone Real Estate, they didn't get lucky. They saw what was coming, positioned themselves accordingly, and bought when blood was running in the streets. Today, we're going to dissect exactly how this crisis unfolded, the behavioral and incentive failures that caused it, and most importantly, what it means for you and me in 2026. Because, as I always say, history doesn't repeat, but it does rhyme. And if you're listening to this show, if you're paying attention to what's happening in commercial real estate today, the rhyme is getting louder. And the savings and loan crisis is interesting, which is what we're talking about today, because so many big things have happened since then that it's sort of faded into oblivion, into the shadows of the past. Many younger investors, myself included, didn't live through it or were very young when it happened, and so don't remember the devastating impact that it had on this country. And that is how crises repeat. That is how they come again and again. They fade away into the history books and the textbooks. And if you have an MBA, maybe you learn about it in your MBA program, or if you took a finance degree, maybe you learn it there. But they sort of disappear from the public consciousness. And then they are allowed to reiterate because ultimately, history matters because people drive history. And people's behavior, the psychology, the behavioral finance that drives our collective actions as a species come again and again and again because nothing really changes. Welcome back to the Timeless Investors Show. I'm Arie van Gemeren, real estate fund manager, student of history, and your host today. So let's get into this thing. To understand how this crisis created so much wealth for patient capital, you first really need to understand what savings and loans actually were. So picture this. It's 1955. You want to buy a house in suburban America. You walk into your local savings and loan. It's a small building, probably on Main Street. The manager knows your name. Maybe he goes to church with your parents, or you play golf with him. These weren't the big money center banks that we have today. S&Ls were community institutions. They took deposits from local savers, and they made mortgage and loans to local home buyers. That was essentially their entire business model. And it worked. For decades, it worked beautifully. The industry operated under what was affectionately called the 3-6-3 rule. Borrow at 3%, lend at 6%, be on the golf course by 3 p.m. Pretty good gig if you can get it. It was boring, stable, profitable, the kind of business that builds wealth slowly and steadily over generations. But the entire business model contained a seriously fatal structural flaw. S&Ls were borrowing short and lending long. What that means, their liabilities were short-term deposits that could be withdrawn anytime. Their assets were 30-year fixed-rate mortgages. This duration mismatch worked fine when interest rates were stable, but if rates ever moved dramatically in any direction, the entire model would blow up. But nobody cared because rates had been stable for decades. So why worry about a risk that had never materialized? Famous last words, always. And borrowing short and lending long is eternally a terrible idea. And eventually you run into a ditch and you blow up. That's what happens. From 2010 to 2022, an entire generation of real estate investors grew up believing that interest rates only went in one direction, down or flat. Bridge loans at 3%. SOFR caps that cost nothing. Floating rate debt was smart because why lock in higher rates when the Fed had your back? The S&L executives of the 1970s made the exact same miscalculation. They assumed the environment that made them successful would last forever, which, again, is a cyclical thing and repeats over and over and over in the history of human-driven financial catastrophes. And of course, the environment that made them successful didn't last forever. So the S&L crisis didn't happen overnight. It unfolded in phases, each one driven by a distinct set of behavioral failures and perverse incentives. Understanding these phases is crucial because we're watching some similar dynamics play out right now. So phase one, the interest rate spike. In 1979, Paul Volcker became chairman of the Federal Reserve. Inflation was running at 13%. The dollar was in free fall. America's credibility as a global economic power was at stake. Volcker did what needed to be done. He raised the federal funds rate to 20%. I've done an entire episode on Volcker and what it took to break inflation. If you haven't listened to it, go back and check it out, and I'll make sure to reference it in the show notes. But for our purposes today, understand this. When Volcker cranked rates, the S&L business model immediately imploded. Think about the math. You're an S&L. Your assets are 30-year mortgages you wrote in the 1970s at 6% fixed interest rates. Your liabilities are deposits where you're now paying 15% to keep savers from fleeing to money market funds. You're paying 15% and you're earning 6%. So every single day you are bleeding money. Not because the loans are bad. The mortgages were fine. Homeowners were paying, but the interest rate mismatch was destroying you. By 1982, virtually the entire S&L industry was technically insolvent. The losses were staggering. The question was, what do we do about it? And here's where behavioral failures begin. The regulators faced a choice. They could shut down hundreds of insolvent S&Ls, which would be politically catastrophic. Or they could pretend the problem didn't exist and hope rates came back down. What do you think they chose to do? The politically difficult and hard thing that would have solved, nipped the problem right in the bud? Or the easy thing that's good for a politician? I'm going to guess they chose to pretend, right? This is what we call regulatory forbearance. And it's literally one of the most dangerous phrases in financial history. It means we know you're insolvent, but we're going to let you keep operating anyways. Why? Because admitting the problem would require admitting failure. Politicians would have to explain to voters why hundreds of community banks were being shut down. Regulators would have to admit that they'd missed the risk. Better to kick the can down the road and hope that it resolves itself. This is a classic case of what behavioral economists call loss aversion. The pain of admitting a loss today feels worse than the potential of a much larger loss tomorrow. So we avoid the certain small pain, or larger pain in this case, but still smaller than what came, and gamble on an uncertain larger pain down the road. But it gets worse. Congress didn't just let insolvent S&Ls keep operating. They actively deregulated them. The Depository Institutions Deregulation Act of 1980 and the Garn-St. Germain Act of 1982 removed the geographic restrictions that had kept S&Ls focused on their local markets. They allowed S&Ls to make commercial real estate loans for the first time. And critically, they increased FDIC insurance from $40,000 to $100,000 per account. Please contemplate that just for a second. We took institutions that were already insolvent. We removed the guardrails that had kept them conservative in the first place, and then we increased the government guarantee on their deposits. This is literally moral hazard in its purest form. And this is why the S&L crisis is fascinating and important for all investors to remember, because there's so many factors to this. So if you're an S&L executive in 1983, what are your incentives? You're already technically bankrupt. Your equity is wiped out, but you're still being allowed to operate. And the government is guaranteeing your deposits up to $100,000 so you can attract all the capital you want. You have exactly one rational strategy at this point: gamble for your own resurrection. If you make conservative loans and slowly lose money, you're guaranteed to fail. But if you make risky bets and they pay off, you might survive. And if those risky bets fail, well, you were already bankrupt anyways, and the government will pick up the tab through deposit insurance. Heads, I win. Tails, the taxpayer loses. It's a great system, right? And by the way, we've seen this pattern play out many times since then. So what happened next is one of the most spectacular examples of herding bias in financial history. Oil prices were high. Texas was booming. And suddenly, every deregulated S&L in America wanted in on the action. They started lending aggressively on office buildings, shopping centers, land developments. Spec deals everywhere. Buildings getting financed before there was any tenant demand. The see-through office buildings of Houston became infamous. Glass towers with no tenants, financed by S&Ls betting on perpetual Texas growth. Sounds very similar to what we just went through, by the way. And because so many S&Ls were piling into the same trade, they all validated each other. Everyone's lending in Houston. The market must be good. This is literally herding bias at its most dangerous. When you see everyone around you doing the same thing, you feel safe. You feel validated. The crowd provides you with psychological comfort. Surely all of these smart people that I know and trust can't possibly be wrong. And here's what herding bias often misses. When everyone crowds into the same trade, the trade becomes crowded. Supply explodes, and then the music stops, and there's no one left to buy. This is exactly what the Sun Belt just went through, by the way. Everybody was herding into the exact same markets and doing the exact same thing. And I just saw some data yesterday about mass vacancy, delinquency, like significant issues happening in these markets now. But everybody had the same thesis. Everyone's investing there. The fundamentals must be good. Cap rates compressed to levels that made no mathematical sense, but it felt safe because everyone was doing it. The S&L executives of the 1980s were not stupid. They were professionals, professionals, if you will. They just got caught in the same trap that every generation of investors runs into, confusing consensus with correctness. And then there was fraud. Names like Don Dixon and Charles Keating became synonymous with the crisis. Dixon famously spent S&L depositor money on a $500,000 beach house and private jets. Keating's Lincoln savings and loan collapse cost taxpayers $3.4 billion and destroyed the life savings of 23,000 mostly elderly depositors. But here's the thing about fraud, guys. It was enabled by the incentive structure. When you let insolvent institutions keep operating, when you guarantee their deposits with taxpayer money, when you remove regulatory oversight, fraud becomes inevitable. It is going to happen. Not because people are inherently evil, right? But because the system selected for bad actors in the first place. The honest S&L executives who wanted to operate conservatively, they couldn't compete, right? They couldn't compete. So you're just left with the bad ones. They couldn't offer the same deposit rates as the gamblers and the fraudsters. So they either joined the game or they got pushed out. Bad incentives don't just allow bad behavior, they select for it. So in 1986, oil prices collapsed and crashed. The Texas economy imploded. And suddenly, all those see-through office buildings had no hope of ever finding tenants. Office vacancy rates in Houston hit 30%. In some submarkets, 40%. Loan defaults cascaded through the system. Between 1986 and 1995, 1,043 S&Ls failed. The Resolution Trust Corporation alone closed 747 of them. The total cost to taxpayers, over $130 billion. In today's dollars, that's north of $350 billion. But here's where things get interesting for investors. On August 9th, 1989, Congress created the Resolution Trust Corporation. Its mandate was simple. Seize failed S&Ls, take control of their assets, and liquidate them as quickly as possible. $450 billion in assets, office buildings, shopping centers, apartment complexes, land holdings, half-built developments, non-performing loans. And here's the critical piece. The RTC had to sell fast. The political pressure was immense. Taxpayers, justifiably, were furious. Every month that the RTC held assets, the cost grew. There was no luxury of waiting for the market to recover. They needed to move. This is the definition of a forced seller. Now, if you've been following this show, you know what happens when forced sellers meet patient capital. The forced seller has no leverage, none. They cannot wait for better prices. They cannot negotiate from strength, and they have to sell regardless of what the market is offering. And in 1989, the market was not offering very much. Banks weren't lending. Investors were terrified. The headlines screamed that commercial real estate was dead. Anyone who'd made money in the 1980s had lost it. The smart money was staying away. Except it wasn't the smart money. It was the scared money. And scared money always loses to patient capital. So let me tell you about three operators who understood exactly what was happening. Three investors who saw the RTC not as a disaster, but as the opportunity of a lifetime. Let's start with Sam Zell. I love Sam Zell. Sam Zell was already famous by 1989. He'd been buying distressed real estate since the 1970s, earning the nickname the Grave Dancer for his willingness to buy from financial corpses. And here's what made Zell different. He didn't just buy distressed assets, he also created opportunity funds specifically designed to capitalize on the RTC liquidation. And he raised capital before the crisis peaked. He had dry powder ready when everyone else was scrambling. And when the RTC started selling, Zell was first in line. His strategy was surgical. Buy at 30 to 50 cents on the dollar, focus on fundamentally sound properties that were crushed by bad debt, not bad fundamentals. Fix the operations, wait for the recovery. The office buildings he bought became equity office properties. The apartments became equity residential. Two of the largest REITs in American history, both built on the bones of the S&L crisis. Zell once said, the single best time to buy real estate is when nobody else wants to. Nobody wanted real estate in 1989. That's exactly why Zell was buying. Number 2, Barry Sternlicht. He was in his early 30s when the RTC was created. He wasn't a legend yet. He was a young operator who saw what others couldn't or wouldn't see. So in 1991, Sternlicht founded Starwood Capital Group with a simple thesis. The RTC is selling hotel assets at prices that make no sense. Properties trading for $30,000 to $40,000 per room that cost over $100,000 to build. Consider that math for a second. You could buy an existing hotel for a third of what it would cost to build a new one. Even if occupancy was terrible, even if the market took years to recover, you had a massive margin of safety. Sternlicht assembled a hotel portfolio from RTC assets, eventually creating Starwood Hotels and Resorts. By his mid-30s, he was a billionaire. His edge wasn't genius, it was courage. He was willing to act when everyone else was frozen. And then there's Blackstone. Oh, Blackstone. They launched a real estate opportunity fund specifically to buy from the RTC, and they understood something profound. Institutional capital was frozen, but the opportunities were institutional scale. Most individual investors couldn't write a $50 million check for an office tower. Most institutions were too scared to try. But Blackstone raised capital from sophisticated investors who understood distress cycles, and they deployed it methodically. Apartments, office buildings, hotels, they bought everything the RTC was selling, always at prices that provided a massive cushion against further declines. Today, Blackstone Real Estate is the largest real estate platform in the world. The empire was built on the foundation laid during the S&L crisis. Now, these 3 investors all had very different styles, but they all followed a relatively similar playbook. First, they raised capital before the crisis peaked. They didn't wait until the distress was obvious to everyone. They positioned early. Whenever I talk to people getting into real estate today, I don't think we're heading into an S&L crisis type situation. Maybe, could be wrong. But I always say, start building your relationships. Start finding people that want to fund deals. Start talking to investors about what's going on, because when there's opportunity is when capital is scarcest. So figure out how to have capital available. And the easiest answer, unless you're a listener who happens to be a family office that has a bunch of money ready to deploy, most of us mere mortals have to work with our own limited means and those around us. So build relationships to be able to source capital now. Second, critical, just kind of hit on it. They had dry powder ready when the crisis and the assets hit the market. While others were trying to raise money at the time to get onto it, they were deploying it. Third, they bought from 4 sellers. The RTC had to sell. That desperation transferred value from the seller to the buyer. Fourth, they focused on good assets in bad situations. They were not buying toxic waste in bad situations. They were buying real buildings in real markets that had simply been crushed by bad debt and bad timing. Something you will hear me say over and over again on this show. It's never really the building. It's almost always the debt that destroys it. And yes, there are some bad buildings and buildings that you shouldn't touch, right? And there are some assets you shouldn't touch, and like don't touch them. But oftentimes, the way people lose money in real estate is the debt. Okay, the debt is the killer. Fifth, they fixed the operations. They understood how to run buildings and create value through execution. And number 6, they held through the recovery. They didn't flip to the next distressed buyer at a 10% gain. They held until the market fully recovered and then some. Classic. Long-term orientation. And the other thing is, no matter what crisis we're in, it will end. It always ends, okay? Barring the complete collapse of this country or some horrific event. Crises end, assets recover. Time solves most problems in investing if you can hang on. The key is to hang on. And what makes it so you can't hang on? Bad debt. That's right. Bad debt. Come back to my original point. Bad debt makes it so you can't hang on. Hang on. The math was simple for these guys. Buy at 30 to 50 cents on the dollar, wait, win. The hard part isn't the math. The hard part was having the psychological fortitude to act when everyone around you was panicking. When there's blood in the streets, it's time to strike. But that's the time when you least want to strike, right? Everyone doubts you. Oh, you're crazy. Why would you do that? You're trying to buy a falling knife, blah, 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 blah. So what if it's a falling knife? Consider this for a second. What if you're in early and the value continues to go down? Do you care if you have a 10-year or 15-year fixed rate loan on a real estate purchase? What if you're 2 years early, but you got it at a 50% discount? We know it comes back eventually. So what if you get in early? I always thought this with the stock market. So what if you enter early, right? When I was an equity research analyst, we talk about this all the time. What if you bought early in 2008? So what? You lost 20% more. Okay. Like, you still bought at a huge discount. And by the way, the stock market's way above the high from before '08. Long-term orientation, patience, and good debt solves most of these problems. So let me bring this back to my favorite topic of all time, which is behavioral finance, because the S&L crisis is a gold standard, in my opinion, for how psychology can drive markets. First, overconfidence bias. The S&L executives who loaded up on Texas real estate believed they had an edge. They thought they understood the market. They thought they were smarter than everyone around them, and they weren't. They were confusing a favorable environment with personal skill. Classic operator mistake. Happens in every single cycle over and over and over again. When every deal works or looks like it's working, you start to believe you're a genius. You do. And you forget that the tide was lifting all the boats. And when the tide goes out, to quote my main man, Warren Buffett, you discover who's swimming naked. And in this case, everybody was swimming naked. It was a party in the ocean. Not a good idea. Second, herding bias. We already hit on it, but I'm just going to retap on this again because it's really important. Everyone was lending in Houston, so lending in Houston must be safe. The crowd provides psychological cover for terrible decisions. I often say, there's nothing more painful than being out by yourself on a thesis and everybody doubting you. We are not designed to survive immense doubt from society. It is in our nature to seek consensus. We, as a social species, rely upon consensus, rely upon approval, rely upon uniformity of opinion to survive. If you think about it in the old days, I mean the old days, you're a caveman. Everybody wants to stay put. You want to go out and hunt. You're the only one doing it because you think there's a unique edge and opportunity right now. And like the woolly mammoth herd is a little tired because there's not a lot of grass to eat. And like, this is the opportunity, but no one wants to go. You're still like, you could still get killed, right? Like there's a reason that you want the other men to join you and to go hunt together. You need it. We need it. It's really difficult to avoid it. And like, you'd rather fail conventionally than fail unconventionally, right? Like one of the comments we often make in the financial business is like, and it's a reason a lot of family offices today prefer to invest with brand names, even though their returns aren't great. Why? Because they're all doing it. It's everywhere in the industry. It's a constant thing. Loss aversion, famous and very important behavioral finance mistake. The regulators who allowed forbearance were motivated by loss aversion, of course. And meeting the problem today would be painful. So they delayed, hoping it would resolve itself. One of the great geopolitical catastrophes for the United States was the Vietnam War. I would argue the Vietnam War is a perfect case of loss aversion, right? Let's just keep pouring funds in because we've already lost so many men, so many resources. We've already expended so much political capital on this thing. We got to stick the course. We got to stay to it. And I know that sort of contradicts what I said about being patient. This is a little bit different. They're incentivizing bad actors and bad organizations to continue to perpetuate a bad business to avoid the pain of anything else. And then there's the principled agent problem. Here's the incentive issue that made everything worse. The S&L executives who gambled for resurrection were not risking their own money. They were risking depositor money that was guaranteed by the government. Their upside was unlimited. Their downside was someone else's problem. This is the danger of misaligned incentives. When the person making decisions doesn't bear the consequence of those decisions, bad outcomes become, I think, inevitable eventually. And we see versions of this in all businesses and in all times, right? People take risks with other people's money. I know in this episode, I talked about raising capital from other investors. I think the difference is if you raise capital from other investors, you suffer serious reputational risks and the inability to continue to be in business, which, by the way, so did the S&L executives, but they were not going to go personally bankrupt if the S&L failed, even though they might bankrupt some of their depositors, and many of them did. So let's bring this home now. Why does the S&L crisis matter right now? We're watching this rhythm of history, this pattern unfold in real time right now. $1.5 trillion in commercial real estate debt is maturing between the end of 25 through 27. Much of this debt was originated in low interest rate times, 2020 to 2021. And I've done a whole episode on this. CRE maturity wall coming, lots of loans expiring. We even have a case of regulatory forbearance, right? The government has told banks that they're going to look the other way if they want to extend and pretend and help people deal with this. So we have a sort of an insolvency style situation. And the government is enabling regulators. The regulators are enabling the banks to kind of just perpetuate the problem by pushing it. I'll link this episode as well because it's critical. But this is huge, right? Properties purchased at 4% cap rates with 3% bridge loan, maybe 3% cap rates with 3% bridge loans, now need to refinance at 6 to 8%. The math isn't mathing, and many of these deals don't cash flow at current debt numbers, much nonetheless 7 to 8%. Regional banks are under stress. Office is already in a slow-moving but very foreseeable crisis that's coming. Some multifamily, especially in the Sun Belt, have significant distress brewing. This sounds and feels very familiar to the SNL I just described. There are differences. We don't have government-orchestrated forced selling like the RTC yet. Lenders are extending and pretending, as I said, hoping that Fed rate cuts will bail them out. But here's the thing about extend and pretend. It only works if the problem is temporary. If rates stay elevated, if the fundamentals don't improve, extending just delays inevitable. And the longer you delay, the more the problems can compound. The SNL regulators tried a form of extending and pretending, and it made the eventual crash worse, not better. So if you believe as I do that we're entering a period of potentially significant commercial real estate distress, here's the playbook that worked in 1989. Raise capital now, before the distress peaks, before everyone realizes what's happening. The best opportunities go to those who have dry powder ready, not those who scramble to raise the money when the deals actually hit. Build relationships with distressed lenders. The forced selling will come through banks and special servicers first. Know who they are. Understand their process. Be on their call list when they need to move assets. Know your market deeply. When distressed assets hit, you need to move fast. You cannot start from scratch on market research. You need to know instantly whether a deal makes sense. Focus on good assets in bad situations. Not every distressed property is a good buy. You're buying a distressed building that hasn't had CapEx done in a decade because the owner hasn't been able to afford it, and you're walking into a massive project. I don't know if I would do that deal, to be honest with you. I might. Depends on the price. If it's 10 cents on the dollar, sure, probably make it work. But understand it and understand your market. You want properties where the debt was the problem, not the real estate. Have the operational capabilities. You cannot just be a capital allocator, not in real estate. You need to know how to run buildings. That's where the value creation happens. I tell people all the time, if you're trying to get into the business, buy something local, buy something nearby, and manage it yourself. Figure out how to do it. Everybody wants to just give it to a third-party manager because it's easier. It's the path of least resistance. I did that, by the way. I'm guilty of my own things I argue here. Don't do that. Manage it yourself. I know it's uncomfortable. You don't want to talk to residents. You don't want to tell them their rent's due and why are they late, blah, 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 blah. But that skill set is critical. Like, you have to learn and be prepared to hold. Don't try to flip. The real money is made holding through the full recovery cycle. So here's my view on timing. The deployment window opens when prices hit bottom and everyone is terrified. It closes when recovery becomes obvious and capital floods back in. San Francisco is a good example of this. San Francisco has been a relatively distressed market since the start of COVID. We looked at buying in San Francisco 2 years ago, to my credit. I'm going to toot my own horn here for a second. I could tell, knowing everything I know, obviously San Francisco will recover. It's not really a question, right? It's going to recover. It's like 7 miles by 7 miles. It has beautiful real estate. The advantages that Silicon Valley provides to the Bay Area are huge, and they're not going away. They're not going away. Venture funding continues to be huge in California. They have Stanford, they have Cal, they have a host of other incredible universities, UCSF. There's so many, producing top-tier talent, top-tier research, top-tier employees, new idea generation. And the other thing that people miss oftentimes in assessing markets and thinking about, like, oh, where's the next Silicon Valley going to be? The confluence of wealth, angel investing, capital sloshing around in the Bay Area, it is inevitable. The Bay Area will recover. So we looked at San Francisco 2 years ago, and prices were distressed. You could see 6 cap deals in San Francisco proper, which is unheard of for this city, right? This is a city that is the gateway to the Pacific. Money flows into SF. Value creation is enormous, but everyone was scared. We didn't buy in San Francisco, not because I didn't believe in the opportunity, but because some markets like this, I think Manhattan falls in this bucket as well. You really got to be a local operator. It's a very who knows who market. You got to be in the flow. Salt Lake City sort of falls in this bucket as well. So we didn't do it because we didn't think we could find the best deals. But the news is out. The recovery's on. San Francisco is having like 15% year-over-year rent increases. Money is flooding back in. People are flooding back into the city. The AI boom is in full force in San Francisco. Office space is getting leased up. It's too late now. Potentially not. Potentially, like, we're at the beginning of the next cycle. But the point is, when the recovery becomes obvious, capital floods back in. The recovery in San Francisco is now obvious, and the capital is flooding back in. But generally speaking, across this country, we are not at the bottom yet. Lenders are still extending. Sponsors are still pretending. The forced selling hasn't really begun. But I believe it is coming. The maturities won't wait forever. The math doesn't lie. Properties that cannot service their debt eventually get sold or foreclosed. My estimate is that the window really opens later this year. By 2028 or 2029, institutional capital will be flooding back in and the best opportunities will be gone. So you have 24 to 36 months to position. So let me leave you with this. In 1989, everybody knew real estate was dead. The headline said so. The bank said so. Your neighbor said so. And that's exactly when Sam Zell, Barry Sternlicht, and Blackstone made billions. They weren't lucky. They weren't geniuses. I mean, there might have been some geniuses there, but they were prepared. They understood the cycle and they had capital ready, and they had the psychological fortitude, the intestinal fortitude to act when everyone else was frozen. Some similar opportunities are forming right now. Not exactly the same. History rhymes. It doesn't repeat verbatim, but the pattern is unmistakable. Over-leveraged assets are struggling. Forced sellers are emerging. Patient capital is positioning. Which side do you want to be on? Will you be the one selling in distress because you weren't prepared? And for those of us, myself included, that own assets right now, managing through this period is what will give us scars. And those of us that survive will keep us in the business through the next cycle and make us much better investors as we go forward. Or do you want to be buying right now, ready to build wealth while others panic? The grave dancers are warming up. The time to decide if you want to join the dance. Thanks for listening to the Timeless Investor Show. If you enjoyed this episode, please subscribe, share it with someone serious about building real wealth, and join me next time as we continue exploring timeless lessons for modern builders. Think well, act wisely, build something timeless.